Candlestick charts are like a compass in the investment world. They simplify the complex movements of the markets, making them more understandable. At their core, these charts reflect the emotions of investors and market behaviors. Recognizing changes in price movements and understanding the sentiments of market participants provide a critical advantage for successful investments. Learning how to read these charts can help investors identify potential trend reversals early. For instance, if a friend asks you when to buy or sell while trading stocks, you might tell them about candlestick charts. These charts take the pulse of the market and whisper to the investor when it's time to act. When candlestick charts are combined with the classic technical analysis methods of the West, they become even more effective. Much like two different cultures coming together to create a rich mosaic, these two analysis methods merge to offer investors a broader perspective. Gaining the skill to read charts and using these techniques together to increase profitability is a significant advantage. Candlestick charts simplify complex financial information, making it easier for investors to make decisions. Looking at the history and development of these charts, the contributions of Japanese trader Munehisa Homa stand out. While trading in Japan's rice market in the 1750s, Homa laid the foundations of candlestick charts by observing rice prices and trader psychology. This type of chart helped Japanese traders better understand the psychology of traders and market conditions. Centuries later, thanks to the efforts of Steve Nisson, candlestick charts were introduced to the Western world and quickly became popular. Nisson transformed candlestick charts into a powerful analysis tool by blending them with Western technical analysis. Candlestick charts contain the same price data as bar charts, but reflect investor psychology more clearly. These charts show the difference between opening and closing prices with colored boxes, making it easy to understand the dominance of bulls or bears in the market. They provide short-term signals, especially for swing traders, and help develop precise entry-exit strategies. However, candlestick charts also have limitations. They offer a short-term perspective and do not provide price targets. Still, the depth and analytical capability they offer make them an indispensable tool. Candlestick charts are an effective method for visualizing price movements and are used as an analytical tool in many markets. In these charts, each candlestick represents the opening, highest, lowest, and closing prices. The real body shows the difference between the opening and closing prices, while the shadows represent the highest and lowest prices during the trading session. A white, empty body indicates that the price rose after opening, while a black, filled body indicates a decline. The appeal of candlestick charts lies in their ability to make it easy to see market trends and movement strength at a glance. For example, a long real body indicates a strong price movement, while short bodies or long shadows may suggest indecision or weakening strength in the market. In real life, a stock may appear to be rising, but if this rise is supported by weak candlesticks, it might actually be a sign of weakening. These charts offer investors clues about the market's direction and momentum. For instance, the opening and closing prices during daytime sessions provide valuable information about the market's emotional state and play a critical role in strategy formation. Understanding the language of candlestick charts can help investors decipher market psychology. Long candlesticks are strong indicators of market trends. For example, a long white candlestick seen during an uptrend indicates that the bulls maintained control throughout the session. This could signal the beginning of a new upward trend. However, if a long white candlestick is seen towards the end of an uptrend, it may indicate that buyers are reaching exhaustion, potentially followed by a decline. On the other hand, Long black candlesticks indicate a bearish trend. A long black candlestick seen after an uptrend may signal a potential downturn. Such candlesticks can be an indication of a market direction change and serve as a noteworthy warning for investors. Short candlesticks reflect uncertainty and indecision in the market. They show situations where prices move within a narrow range, and neither bulls nor bears can establish dominance. For instance, a short candlestick following a significant movement may indicate a loss of momentum, reminding investors to be cautious. Interpreting candlestick charts correctly offers investors the opportunity to keep a pulse on the market and adjust their strategies accordingly. These charts are an effective way to understand the market's current mood. In these charts, bulls and bears, namely buyers and sellers, are in constant struggle. The first 90 minutes may start with the dominance of the bulls. Then the bears step in and drive the price down. However, the bulls regain control and push the price back up. These movements are represented by the upper and lower shadows in the daily candlestick. While prices change continuously throughout the day, the closing price reflects the general perception of the market at the end of the session. You can use candlestick charts across different time frames. Day traders may use candlesticks on shorter time frames, while long-term investors might look at weekly and daily charts. These charts help you understand market trends and make quicker decisions. However, it's important not just to learn these patterns, but also to understand market psychology. Initially, learning too many patterns can be overwhelming. Starting with a learn less but learn better approach can be more effective in the long run. In other words, correctly understanding the clues provided by candlestick charts will strengthen your investment decisions. In the book Mumgrafikleri, it is emphasized that price movements and market volatility can vary across different markets and stocks. That is, while a pattern may be frequently seen in one market, it might be rare in another. A standard format is recommended for understanding these patterns. This format includes elements such as price action before the formation, the description and psychology of the pattern, real-world examples, and variations. Even non-ideal formations can provide important clues about investor psychology. In particular, hanging man and hammer formations indicate points where price movements may reverse. The hanging man formation appears after an uptrend, signaling a downturn, while the hammer formation offers a bullish signal after a decline. Both patterns are characterized by a small real body and a long lower shadow. For example, if a stock price falls during the day and bulls push the price up by the end of the day, this may signal a potential price change. With real-world examples, it's possible to see whether these formations are effective. Traders can make more informed decisions by evaluating these signals alongside other indicators in the market. Candlestick charts are powerful tools used to understand price movements in financial markets. The hammer formation occurs at the end of a downtrend and often signals that prices might recover. The hammer is noteworthy for its long lower shadow and small body. For example, if a stock shows a hammer formation after a few days of decline, it may indicate that the price could recover and investors might consider buying. On the other hand, shooting star and inverted hammer formations provide contrary signals about price movements. The shooting star typically appears at the end of an uptrend and may signal a shift to a downturn. The inverted hammer, however, forms after a downtrend and suggests that an uptrend could begin. These formations offer important clues that investors should reassess their positions. For instance, if a stock shows a shooting star formation during an uptrend, it might signal that investors should consider taking profits. Lastly, the doji formation represents a situation where the opening and closing prices are nearly the same. This indicates market indecision and the possibility of a trend change. A doji should be closely watched, especially if it appears at the end of an uptrend or downtrend, as it may signal a potential trend reversal. For instance, if a stock price has been rising for a long time and a doji formation appears, this could be a warning for investors. In the world of candlestick charts, patterns like long-legged doji and gravestone doji offer important signals for investors. The long-legged doji indicates that both bulls and bears engaged in a fierce battle throughout the session, but neither side emerged victorious in the end. This suggests that the market has lost its directional sense, and when you spot such a pattern, you might want to carefully review your investment decisions. The gravestone doji, on the other hand, becomes prominent especially after price increases and provides a strong bearish signal at market peaks. In this pattern, the opening and closing prices are nearly the same, indicating that the market returned to the same level after a sharp upward movement. The long upper shadow of the gravestone doji symbolizes that prices reached a peak during the session, but bears took control afterwards. The dragonfly doji also offers another critical signal for investors. Its long lower shadow suggests that the market might recover from a decline. These patterns provide important clues for investors looking to capture turning points in the market. Remember, such technical analysis tools should always be evaluated along with other market data. Let's talk about an exciting topic related to candlestick charts: engulfing and piercing candlestick formations. First, let's discuss the piercing formation. Here, the deeper the body of the second candlestick penetrates into the body of the previous bearish candlestick, the higher the probability of an uptrend. This is considered a reversal signal in the charts. If the body of the second candlestick does not close at least halfway into the body of the previous candlestick, investors often prefer to wait for additional confirmation. This is typically achieved when the price trades above the piercing candlestick in the next session. Engulfing formations, on the other hand, can signal sudden changes in the market. Here, a strong second candlestick completely engulfs the body of the first candlestick. For example, a bullish engulfing formation occurring during a downtrend may indicate that prices will rise again. An example can be seen in the chart of BioMarin Pharmaceuticals, where a strong bullish engulfing formation led to a price recovery. These formations provide critical signals for investors and are closely watched by many. These patterns reflect sudden changes in investor psychology and can lead to significant movements in the market. Thus, understanding these formations can help you make more informed decisions in the stock market. The harami formation is a candlestick pattern that indicates a potential reversal in price movements in financial markets. It consists of two candlesticks. The first candlestick has a long, real body, while the second candlestick has a smaller body and is usually located within the body of the first candlestick. Harami means pregnant in Japanese, and this formation gets its name because a small candlestick is nestled within a larger one. The colors can vary, but typically the second candlestick's color is opposite to that of the first candlestick. The bearish harami is seen after a price rise and indicates a potential bearish trend in the market. This means investors should be cautious. For example, if a stock shows a bearish harami formation after a prolonged rise, investors might consider realizing their profits. The bullish harami, however, forms after a downtrend and indicates that prices might rise. Investors might view this formation as a buying opportunity. Although harami formations are not as strong as engulfing formations, they are considered a warning signal for a potential market direction change. These formations are signs of potential changes in the market that should be watched carefully and can play a significant role in investment decisions. In candlestick charts, formations like the evening star and morning star offer important signals for investors. The evening star is typically seen at the end of an uptrend and signals a downturn. It consists of 3 candlesticks. The first shows a long upward movement. The second is a star representing indecision. And the third is a bearish candlestick that erases the gains of the first candlestick. For example, there is a strong example of this formation on the chart of Copart Inc. in July 2007, where the third candlestick nearly erased the gains of the first candlestick. The morning star, on the other hand, forms at the end of a downtrend and signals a transition to an uptrend. The first candlestick shows a decline, the second symbolizes indecision, and the third breaks this indecision with a rise. The June 2007 chart of Las Vegas Sands is a beautiful example of this formation. The gaps following the first candlestick and the rise of the third candlestick provide a strong signal that the market's direction is changing. These formations are critical for guiding investors' decisions and help in understanding market psychology. Candlestick charts are an essential tool for understanding stock price movements, and there are some critical points to pay attention to when reading these charts. During consolidation periods, prices often fluctuate within a certain range, offering investors opportunities to develop specific strategies. For example, formations like the hanging man and shooting star seen in stocks like OSI Pharmaceuticals can signal reversals in price movements. However, for these formations to be effective, the stock must be in a short-term overbought or oversold condition. Structures like rectangle formations cause prices to be trapped between certain resistance and support levels. This offers investors trading opportunities through short-term price fluctuations. The important thing is to be prepared for rapid price changes that may follow such formations. Therefore, when evaluating price movements, it is essential to consider broader market conditions and possible reversal signals. These signals may not always bring a trend change, but they can offer clues for short-term strategies. It should be remembered that no indicator in technical analysis is 100% reliable, so caution is advised. In candlestick chart analysis, reversal patterns. The most important lessons from this book are: 1. Understanding market psychology. Candlestick charts provide insights into psyche,